Well, good morning, and thank you to all of those who are here joining us for financial tips during challenging times. My name is Jessica Wishan, and I am the CEO of Habitat for Humanity of Southern Santa Barbara County, and I'll be serving as today's webinar host. So we are thankful for everyone joining us, as teaching classes like this is part of our core mission. But usually those classes are in person. Today, we're happy to bring you the same experience over a webinar. We are only able to facilitate such opportunities with the leadership and support of our partners, volunteers, and donors. This is our 20th anniversary year, and we have some important partners and sponsors to thank. Union Bank, US Bank, Russ and Nancy Werner, Hayden Homes with Village Properties, Pacific Western Bank, and Sunrise 805. Before we go any further, I do want to note that this webinar is being recorded and will be updated to our website for you to watch again at a later time or to share with friends. Now, a little bit about Habitat's history and program overview. We were founded in 2000, and we're celebrating again 20 years of building homes, communities, and hope. Our footprint is Southern Santa Barbara County, ranging from the Gaviota area to the north to Carpinteria to the south. And since our inception, we have built 22 homes in this area, and we sell them at an affordable mortgage. The other core part of our mission of particular importance in light of the coronavirus is our home repair programs, where we provide repairs for lower income homeowners as it relates to health and safety. And Habitat is an equal housing and fair housing agency. Next, I wanted to provide a summary of what to expect today. Habitat typically offers a variety of community classes in partnership with businesses and nonprofits in town, offered to our homeowners and repair partners, and usually also open to the wider community. During the unique times that we're in, we realize that how we manage money today may need to look different than a couple months ago. So we wanted to offer a course providing some best practices so you can make the right decision in the present while still thinking about how those current decisions may impact your future. What's up on your screen right now is where you can go to download some resources that you may actually want to do now while you follow along in this webinar. And those resources include a template to download for a budget. It also includes some of the resources that may be available to you. So it's www.sbhabitat.org/financial-tips-webinar. And the screenshot you see is kind of where you go on the web page. So it's news and events, under events, and then you can find the financial tips webinar page. Some general housekeeping. This is going to be about an hour, and all participants are on mute. And if you'd like to ask a question, you may type your question into the chat, and we'll read that question off at the end during our Q&A period. And later in the seminar, you're also going to experience an interactive Zoom poll, so be ready to participate if you're interested. Next, I am about to introduce our speakers, but before I do so, I wanted to take a moment to thank Danica Martyr, Habitat's Development and Administration Coordinator, who is instrumental in making today's webinar possible. And now for our speakers. Reese Morris is a resident of Goleta, California, and is a Managing Director of Residential Lending for Union Bank. Reese has been in the financial industry for over 20 years, focused on residential lending. He lives with his 3 teenagers, and while working for Union Bank, he also volunteers for Habitat for Humanity. Reese has been on the finance committee for 2 years and recently joined the board of directors as treasurer. We also have joining us Levi Hayden, and he is going to be our second speaker today. Levi is a CPA, an incredible volunteer with Habitat. He's a graduate of Westmont College and works at Damitz, Brooks, Nightingale, Turner, and Morissette as a tax supervisor. And he serves on the finance committee for our local Habitat. He has expertise in the areas of real estate and investment partnerships, small businesses, tenant in common arrangements, and deferred like-kind exchanges. Also, a part of our webinar is Ivan Costello. We also have him joining us, and he'll be joining us actually next month as well to help facilitate this webinar in Spanish. We're pleased to include Ivan, who's a graduate of UC Santa Barbara and has 12 years of experience fluent in Spanish as well. Additionally, he's a financial educator and branch manager of Union Bank at the Mesa here in Santa Barbara. Now?
Well, financial literacy is the ability to understand how to make your money work for you, okay? And it is how you manage it, how you invest it, how you spend it. And I'm hoping that during this hour today, we're going to be able to help assist you in making the right decisions that will help you in your everyday life. So if we think of the acronym SMART to begin with for goal setting, right? So when you set goals for spending, you need to be specific, they need to be measurable, they need to be attainable, they need to be relevant to you, and there needs to be a time limit on them. So why do we save money? What is the point of us saving money? So some of the things that are important for our financial goals, we are looking to reduce our debt. We want to establish maybe emergency funds. And really, if you think about it, we're in a time right now that's so important, right? With COVID-19, how it's changed our world. The peace of mind of having emergency funds for such times as this is so important. We purchase small items. And then we look at how can we use our money for down payment on larger things, such as houses and cars. If you're like me, I have 3 teenage children. So I need to pay for education for them, for their books, their tuition, and their fees. And one day, I hope I'll be able to retire. And so it's very important to me that I have enough money that I can retire one day and still pay my bills. We have time off, and so we want to save some money for vacation or travel. And it's imperative and thought also is that our goal is by working hard and being smart about our savings that we'll also accumulate wealth. So those are the reasons that we have on why we save money. So why should you keep track of your money? Well, to begin with, how can you plan if you don't track what you get, right? And I recommend that these days, if you have an iPhone, if you have an Android, it's very easy to go and find a free app, and you can utilize that to keep your budget on a daily basis. So I recommend that you go to the App Store, find a free app, and start utilizing them to track your money. So let me just ask you, how many of you have looked at or changed your budget since COVID-19 has hit? So if you can, just hit the button yes or no, and we'll come back to that later. So how often do you plan your purchases? Often? Never? Sometimes? I recommend you do this. You should have 2 categories. 1 is what you need, and 2 is what you want. And believe me, they're 2 different things. I need a car to take me to work, to take me to school, to take me shopping. I need a car. I want a brand new car. I have to think what my budget will allow me to do. And so this is what I recommend you all do. Get a piece of paper. You sit down tonight, you do 2 columns and you say, what are my needs and what are my wants? And by that, that's a first way that you can start planning your budget in regards to purchasing. You want a spending plan. So let me ask you, say, why do we need a spending plan? Well, like the rest of you, I get a paycheck every single month. And with that paycheck, I have to manage my spending. I have to budget what I have. I need to pay my bills. I need to manage what bills I have. It's also very important that you review your spending. And review every single time you get a credit card statement or a bank statement, go through it. Check to see if there's something on there that doesn't make sense to you. Oftentimes, as we rush through life, we miss things that, hey, maybe that's not my bill. So it's very important to be on top of that. Identify ways to save money. And then buying items that you want or need, make sure that you are disciplined around that. Here's just a sample of a monthly budget. And as you see, you'll see here that it shows you what percentage of your net monthly income that goes on budget. And this is how I would create it. I would put everything that you spend on a monthly basis, put how much you spend on it, and how much of your actual net wages is taken to that. Okay? And before I go any further, I want to make sure that all of you understand that we get every month a gross income, right? If I make $60,000 a year, okay, maybe I get to take home 30 of it. So 30 is actually what we spend. But I recommend that every single one of you, if your company has a 401k plan, that you make sure that out of your gross income, that you are at least maximizing in there what they will match to you for your 401k. So write down, if you have a piece of paper, if you don't know it already, what does my company match for the 401k? And the reason I tell you that is because that is literally free money for you. It's pre-taxed, and most companies now give a 401k match, and that just increases the value that you've got, and that's going to help you for retirement. What line items should every budget include? And this comes back to just what I just said right now. The first item that you should be paying or saving yourself is to make sure that you're getting that 401k. It's also imperative that you are saving for those emergency times like today. That each and every month, it doesn't matter how much it is, that you're putting part of what you're earning as a household income away in savings. And that's whether it's for emergencies, for education, for homes, cars, you name it. You need to have a savings account so that you can start saving for the future. Again, with a budget, there's ways for you to be able to look at your budget. You can review it over the phone. Every single bank now has a mobile app. You have online banking. And yes, some people still use checkbooks and they balance it that way. It doesn't matter. Whichever way that you look at your budgeting on a monthly basis, it's a discipline that's very important for your future, for current times, but it's important that you keep on budget at all times. It's not always easy to stay on budget. And living in Santa Barbara, Goleta, and even in California as a whole, we have to borrow money, right? And it's okay to borrow money. Now, there's good use of debt and there's bad use of debt. Now, good use of debt is such things as buying a home, paying for college. These are things where when you're using debt, it adds value later on in life also. So if you were fortunate enough to buy a home in Santa Barbara in 1970, your home is probably worth 10 times more today than it was back then. And when you borrowed that money from the bank on a mortgage, you thought, oh my word, how am I going to pay this back? But that was good use of your debt. You became a doctor and you have tons of student loans, but you put yourself through college and now you're reaping the rewards of that. That's good use of debt. Now, there's also bad use of debt. And as Jessica said early in this presentation, my job is in real estate. I'm a mortgage loan manager. And so when I look at people's credit report, it tells me the story. And when I see a Marshall's credit card, when I see a Neiman Marcus credit card, when I see lots and lots of different car loans, and that debt to income ratio is really, really high, that's not good use of debt. So where I recommend you decide, oh, you know what, I'm going to go and buy a new outfit. I'm going to go and buy a new outfit. I'm going to go to Marshall's because I can get a good deal at Marshall's. And so you go there and you picked out these items and you got like $100 worth, and you're going up to the counter, and what's the first thing they tell you? Would you like 10% off your bill today or 20% off your bill today? If you apply for the Marshall's credit card, we will give that to you. But you had already walked in and you had the money to buy those. Do not take that credit card. That is not good use of debt. So there's 5 C's of credit. And so when somebody comes to us as lenders, we pay particular attention to these 5 C's of credit when you're applying for a loan. First is character. How responsible do you look on paper? We will review everything from your FICO score, whether it's a positive or negative result, to your employment history. That's what we see on paper. Your capacity. Do you have a good spending plan? Such as, what are you leaving within your budget? Or have you borrowed more money than you can pay back? We will examine that. Your income versus your debt. We will look at capital. Do you save regularly and set aside money for emergencies? We want to know how much money you have in case of unforeseen events, such as a job loss or an emergency. We look at collateral. We look to ensure that you have a financial incentive to repay what we are lending the money for you to buy. In conditions, we look at the current economic conditions. Do you have a stable job? Is it a new job? Are you out of work? And you know, in today's environment, how important all these things are. So I would write down these 5 C's, because whenever you want to buy and use good credit, meaning to buy a house or to even get a car to take you to work, we look at these 5 things to see and make sure that you are a good candidate to borrow. Do you all know where to find your FICO score? Your FICO score is calculated from several different pieces of credit data from your credit report, and they're both positive and negative information. The FICO score is a score that you get, and there's usually 3 scores from 3 different credit bureaus. And For lending on a house, we usually take the middle score, but we look at your entire credit. And really, the FICO is determined on a few things. One of the major components of a FICO is using credit and using it in a smart manner so that you're paying it off on a regular basis, that you're not spending too much, that you have the capability to pay back what you've already lent. These days, it's a lot easier than it was in the past. Personally, I use Credit Karma, and it's fairly accurate, and you get more than one score. And it also tells you on that one what your current balances are, what you can do to improve it, and it gives you a lot of good tips. So for me personally, and I'm in the lending business, I find that Credit Karma is a very, very good one. It's a free app, but it lets you keep up, and it does not affect your score when you look at it. And it will actually update 2 or 3 times a month. There's quite a few of them out there. I recommend that you use them because it does give you kind of a litmus test of where you are credit-wise. And it keeps you honest. It lets you realize where you're at and where you need to get to. In regards to borrowing money, and this is my final slide on this, we look at debt to income ratio. So let me explain to you very simply what that means. Your debt to income ratio is whatever money you get for wages, we take that. And by the way, when it comes to debt to income ratio, we look at your gross income and not your net income. Okay? But what you want to look at is when you look at your income, how much of your income is actually spent on certain aspects of your life. So there's 2 types of debt to income ratio. The first one is your housing ratio. And what we look at in a housing ratio is what are you paying in rent, or what are you paying in mortgage, and what percentage of that is coming out of your salary on a monthly basis. And the litmus test to me, you do not want to be paying at the max more than 30% maximum of what you make on housing. The other part of the debt to income ratio is everything else. All the other debt that you have, a car loan, credit card debt, student loans, any other debt, that is called your overall debt. And so when you add everything together, you need to find out what percentage that is. And what you're hoping for is that you're around 38 to 40% there. The reason being is that we do that calculation off of gross income. And you all know you only take home about 50 to 60% of your income. So the importance of that for you is so that you can remember how much money you have to save on a monthly basis. And the discipline of doing that will give you a very, very happy future. Thank you.
Reese, thank you so much for that valuable information, especially right now. We're pleased to now introduce Levi Hayden, and he's going to cover some tax planning with us.
We find ourselves in, anything we can do to improve our financial situation, to not only help us in the present, but plan for the future, is going to be a benefit. So thank you again for everyone who could join today. And there's a few things that I want to touch on. One of them is related to the CARES Act, which we're all familiar with, was the $1 trillion plus spending bill that was passed by Congress at the outset of this virus. and how it impacts your tax situation. I also want to touch on just tax filings, tax planning in general. And then I also want to piggyback a little bit on what Reese was saying as far as saving, retirement accounts, and planning for the future. So to begin, we're all familiar with the recovery rebates for individuals. Many of you have already gotten your stimulus checks, $1,200 for single taxpayers, $2,400 for married couples filing joint returns. One thing to be aware of is that it is phased out with income over $75,000 for single filers, and it's phased out for joint filers over $150,000. Most individuals will not need to do anything to receive their checks. In fact, if you are in a direct deposit situation with the IRS, where you pay your taxes or you receive refunds, you don't need to do anything at all. You'll get it directly deposited in your bank account. But also, you need to have filed a 2018 or 2019 tax return. If you have not filed, but you do receive Social Security benefits, then you should be able to receive your rebate as well. So that's really all there is to say on the rebates. Most of you, like I said, have already received them. But if you're still waiting, be patient. They will come, and you don't have to really do anything at this moment. So let's move on to some of the tax filing issues. Many of you know that the individual tax filing deadline of April 15th was extended to July 15th, 2020. This includes both federal and California filings. And it also includes the deadline to make estimated tax payments to July 15th. If you cannot file by July 15th, you can still request an extension until October 15th, as in a normal tax year. However, it's important to be aware that even if you do request this extension to October 15th, any taxes due at that July 15th deadline will still be due in order to avoid interest and penalties. Another thing to be aware of is that if you're filing in other states, it's important to check to see if those states have conformed to the federal extension for 2020. Most states have. Most states, you don't have to worry about it, but it's always important to check to see. And then the last thing I want to say about filing your taxes, if you haven't filed yet, if you're expecting a refund, if you're a W-2 wage earner and you've been paying in taxes all year long, you're expecting a refund, file as soon as possible. Get that refund. It's only going to help. You can use that money in the short term. You can use that money for saving, and so on and so forth going forward. Now, here's our poll in regarding to filing taxes. I'm always curious because it really changes from person to person on their situation, how you file. So obviously, if you have a W-2, your situation is really simple. You probably just use the free online software, TurboTax, TaxSlayer, H&R Block online, or do you use a CPA or other tax professional like a tax attorney? Do you do it with pen and paper yourself? Uncommon these days, but I do know people that still do it, and that's absolutely okay. Or do you hand your taxes off to family and friends and do they file for you? I'm really curious to see, because there's no one size fits all for how to file your taxes. It really depends on your situation. So there we go. Looks like TurboTax is the way to go. It is popular. I've used it in the past. It works great for certain filers with situations that are not too involved and too complex. It really is easy to use. So the first thing I really want to touch on here, and this is kind of piggybacking on what Reese was talking about as far as saving for retirement. The use of individual retirement accounts, such as IRAs or qualified compensation plans, such as 401ks, is the best way you can save for the future. There's really no way to beat it. As far as, like Reese said, it's free money. What you're doing is you're putting money away. You're not going to touch it until years and years down the road. And what that money you're putting away now is going to do is it's going to grow, and it's going to grow tax-free. But it's really important to know the different kind of plans that are out there, what is available to you, what your employer might offer. And the two basic plans that I really want to touch on are traditional IRAs and 401ks and Roth IRAs and 401ks. So the basic difference between a traditional and a Roth account is how it's taxed when you contribute it. When you contribute to a traditional account, you defer current year income taxes on the amount that you put away. So if you earn $10,000, you put $1,000 away, that $1,000 in that year you put it in is exempt from income tax. And then that $1,000, as you invest it into the market, securities, bonds, whatever you invested in, even if it's in just a money market, it grows tax-free. So whatever it earns year to year going forward, you do not pay tax in that current year on it. Now, a Roth works a little bit differently in the fact that you take that same $1,000, you put it into a Roth account, but you pay income tax on that $1,000, but it grows tax-free just like a traditional account. Now, why would you contribute to a Roth? Well, the difference is when you pull it out of a Roth, you're only taxed on the earnings that have accumulated over the years. So you put in that $1,000, it grows to, let's just say for simplicity, $2,000 or $5,000. When you pull out that $5,000, you're not taxed on the full five, you're only taxed on the growth of the four. Now with a traditional, because you've deferred taxes on the money you've put in, you are taxed on the full amount of whatever you pull out eventually when you do take that money out for retirement. So which account is going to be best for you? Well, it really is all about the tax bracket you're in when you contribute to the retirement account. If you're a high earner at the moment, if you're in a high tax bracket, you really want to utilize the traditional accounts because they're going to work best for you to defer taxes in a high tax bracket. And then the plan is when you do utilize your retirement account, when you've retired from your job, you're going to be in a lower tax bracket. So that money you take out that otherwise would have been taxed in a high bracket is now going to be taxed in a low bracket. For lower earners, these would be, it can switch from year to year, essentially. Typically, when you're younger, you're a lower earner, or you could maybe utilize both accounts, but essentially, if you're a low earner, you want to contribute to a Roth because you're already in a low tax bracket. So there's no sense to really defer taxes in the current year if you're already paying that low rate. So those are the two things that I really want to emphasize on retirement accounts, the traditional ones and the Roth accounts. And there's traditional IRAs, traditional 401ks, and then there's Roth IRAs and Roth 401ks. Now, there were some changes in the CARES Act that related to retirement accounts that are important to touch on. Essentially, if you have funds invested in an IRA or a defined contribution plan, they're really only eligible for withdrawal until you reach the age of 59 and a half. Now you can take money out before that age, but you're going to incur a 10% penalty. And for 2020 only, because of the crisis that we're in, you can withdraw early and avoid that 10% tax on IRAs and 401ks. Now, I don't recommend, if you don't have to, withdrawing from your retirement account, because like we've been talking about, saving for the future, saving for that time when you retire, knowing you're going to have money in the bank when expenses continue to incur after you retire. It's important to keep that money in there, but we understand that during this time, it is crisis mode for a lot of people. And so if you have a retirement account and you need to take some money out, you can. And the important thing to realize on a technical level is that it's limited to $100,000. But the best part is that any money that you take out from your retirement account can be spread out over 3 years. So let's say you take out a chunk this year because you need it. You don't have to recognize all of that income from your retirement account this year. You can spread it out over 3 years, which will be really helpful for some people. And then the next item and change related to retirement accounts is the waiver of required distribution rules. So the way that retirement accounts work is that you're not supposed to withdraw it until you're 59 and a half. But what the IRS says is basically, once you reach the age of 70 and a half, we're going to make you start withdrawing from your retirement account, because eventually the government wants to get their tax money on what you've deferred. And so for those that are older, those that have retirement accounts where they would have to make that required minimum distribution this year, for 2020 only, that it's called an RMD, the required minimum distribution is waived for 2020. So that's something to be aware of. Now, when it comes to taxes, the other kind of general aspect of taxes I wanted to touch on that's important for planning, and it's important for planning on a year-to-year basis, is understanding the difference between charitable deductions, which is an itemized deduction, and the standard deduction. And I think there is often a lot of misconception in taxes when it comes to taking deductions. Many people think that because they have given some money to a couple charities that no matter what happens, they're going to get that deduction right off their taxes in the year that they give it. But that is not always true. And the reason it's not always true is because there's something called this standard deduction. And you see the amounts listed on the screen: $12,400 for single, married filing separately, $24,800 for married filing jointly, $18,250 for heads of household. Now, these amounts are increased from year to year. So these are amounts for 2020. But one of the big changes in the Tax Cuts and Jobs Act that was passed at the end of 2017 was that these standard deduction amounts were doubled as a result of that tax law. So in the past, they were a lot lower. They were about $6,000 and $12,000 for single and married. So that means that basically the way that the standard deduction interacts with itemized deductions really drastically changed. And the next thing I want to talk about is, what are itemized deductions? We know that a charitable deduction is an itemized deduction, but what else is included in your itemized deductions? Well, we have qualified medical expenses that for the year 2020 is going to be over 10% of adjusted gross income. which means you take your gross income. There's some adjustments that are made to it if you qualify, and then you can only take medical expenses that are over a 10% threshold. You get a deduction for state and local income taxes. So from the federal level, you get a deduction for income taxes paid to California, real estate taxes, if you own a home, but that is capped at $10,000. If you own a home, you pay mortgage interest. You're likely going to be itemizing, but then charitable contributions is also an itemized deduction. So the main thing that I want you to be aware of is that basically, when it comes to charitable giving, it's important to know your other itemized deductions and compare it to your standard deduction. So if you're in a year where you've had high medical expenses or you paid a lot in state and local income taxes, be aware when it comes to the end of year, when you're making your charitable contributions, that you may want to make that in the year you have those other high itemized deductions, so you can take advantage of your charitable contributions and utilize them. Otherwise, like we have on our screen here, that if you have high itemized deductions, but then you don't make that contribution till a month after the year end, those charitable contributions might be lost from a tax perspective. Obviously not lost from the real fact and point of charitable giving, but we want to maximize our deductions on a tax level. And so being aware between itemized standard deduction is really important when it comes to filing your taxes. Another change made by the CARES Act was that in the past, you could give up to 60% of your modified adjusted gross income. And for this year only, it's very liberalized. You can give as much as 100%. And essentially what would happen in the past, if you gave too much in a year, if you gave over that 60%, then those charitable deductions would be cut off and carried forward to the next year. But for this year only, you can give up to 100%. And then the last thing I want to touch on charitable deductions is that this also applies for corporations, that it's generally you can only give 10% of taxable income. It's been increased to 25% for 2020. But the only thing I'd like to add here is that if you own a business, I would always recommend that you give charitable contributions at the individual level. And the reason being is that when you give through a business, especially a corporate entity, your corporation, there are limitations that are much stricter than the individual level, as you can see the percentages here. So I always recommend that if you're looking to give charitable contributions, take the money out of the business and then give it on an individual level, rather than making it a business contribution just for tax purposes. That for a large corporation, giving here and there is a great thing. I'm not saying don't do it, but I'm saying be aware of the limitations, that if you're going to give a lot through your business in one year, be aware of how much income you have and the thresholds here that are listed on your screen. And then the last couple of things I'd like to touch on here that relate to the CARES Act and the current situation that we're in is that there's a lot of business assistance that's available, not only in the form of loans, small business loans, but also just in the tax world, that it's important to be aware of if you are running a business. If you have a business that's been impacted, shut down, partially suspended, lost employees, there are credits that you could qualify that could be really helpful. So eligible employers can qualify for a refundable credit against your Social Security payroll tax. And it's equal to 50% of the wages that you pay to employees. So that means it can be up to $5,000 per employee. That's a credit that will be refunded. So what a refundable credit it means that even if your tax liability is only $1,000 and you have a $5,000 credit, you will get that $4,000 difference as a refund. So the credit is available to employers carrying on businesses that have been fully or partially suspended. And it's also available to employers who have experienced more than a 50% reduction in revenue. So if you've been struggling during this time with your business, but you've kept your employees, be sure to look into this credit because it'll really help you going forward. Also, the couple last things here, also talking about businesses with employees, is that taxpayers, including self-employed, you can defer part of your payroll taxes through the end of 2020. So normally you would have to pay in installments on your payroll taxes, but they are deferred in 2 equal installments, one at the end of 2021 and one at the end of 2022. But the important thing to note down there is that if you've applied for a small business loan and you've received debt forgiveness, then this relief is not available. So that's something to be aware of as well. And then the very last thing I'd like to touch on, and this really relates to the current situation that a lot of people are in, are the net operating loss liberalizations. Now, a net operating loss is just what it sounds like. Essentially, if you're running a business, if you're self-employed, you run for a loss at year end. When it comes down to the individual level, if you have an overall loss of ordinary income from your business, that operating loss is going to be held in the current year and then either carried forward or carried back. Now, the 2017 Tax Act eliminated the ability to carry net operating losses back to prior years. After 2017, if you had a loss, this NOL, you could only carry it forward to offset taxable income in future years, which is a great thing. But one of the changes in the CARES Act is that if you have a net operating loss that arises in tax years before 2021, you can carry back that NOL back 5 years. So it's really important to be aware of that. If you're running a business this year, if you're running at a loss, but in prior years you had high income years, be sure to take that NOL back up to 5 years and get a refund. Really, really important that a lot of people are going to utilize this year. And that's really all I have for you. I hope that was helpful and not too technical, hopefully not too boring, but there really are a lot of things you can take advantage of during this time, especially with the changes. It's constantly changing. Every time legislation comes through, there's new changes. But we have some resources on the website that'll be helpful, and feel free to ask questions away as well.
Levi, thank you. I know personally I learned a lot, and for some of the information there that is complex, again, we'll post both the PowerPoint deck that you're seeing today on our website, as well as the recorded version of the webinar. We're just about to wrap up. We have a few last things we want you to walk away with, and those are just an awareness of resources that may be available to you in light of kind of the health and economic crisis that our communities are experiencing. Some businesses and the government and nonprofits are making some resources available. So We have an entire list, including a description of those resources, along with a hyperlink and an explanation of eligibility for you to take a look at. But if you are a homeowner or a renter, you could get a reduction in, your electricity, even Cox and gas. There's so many different types of benefits available through the EDD. Restaurant workers have some resources available. So this slide is not where the links are, but again, on our website, we have a resources page with those links available. And even more extensive are the resources available through 211 Santa Barbara. And you can either call them or go on their website, and we've listed their information as well. So that's on sbhabitat.org. So a lot of information today, hopefully helpful. What we want you to walk away with remembering is create a budget and stick to it, and make sure it's really reflecting the current times. One of the best ways you can save for the future is by utilizing individual retirement accounts or qualified for 401k plans. A reminder that the deadline to file individual tax returns has been extended from April 15th until July 15th, and there may be another extension available to you until October. But as Levi said, if you're expecting a return, it may be wise to file and get that return as soon as possible. And that eligible employers can qualify for a refundable credit against the employer's Social Security payroll tax equal to 50% of wages. And that's about wrapping things up. We do have a Q&A box. We're going to pause here if there's any questions, but we have not seen any questions come through in the chat box. I'll wait just a second and see if anything pops up. All right, we'll go on to the next slide. So thank you again for watching. Thank you to our volunteers, Reese and Levi. We're going to be following up with a survey to get your feedback on today's webinar, as well as receive input from you on topics for future webinars that may be helpful. Really important is Habitat's going to provide this same webinar in June in Spanish. We have a tentative date, but we're going to email and reach out to our community with the confirmed date. And again, you're going to be able to find this recording online. So thanks again so much. Thanks for joining us. Sending all the best to you guys.